All right, we should be good. Let's see. Hey everybody, welcome. If you can hear me, please drop a 1 in the chat. All right, ones, nice. Perfect. And Rye, if you could say hello, please drop a 2 in the chat if you can hear Rye.
Yes, if you can hear me, please put a 2 so we know that the audio is working on the YouTube side. Please press 2.
Yep, and drop a 3 if you can see the slides clearly. All right, lots of 1s and 2s.
Okay.
Perfect. Yeah, just a quick thing before we get started. We're using YouTube because Zoom actually caps us at 500 traders, and we've gotten a lot more than that the previous webinars. So we decided to kind of bring it to YouTube so anybody who'd like to can join, and this way you'll have immediate access to the replay afterwards. So I think this is the best of both worlds. But thank you guys so much for joining. While we just give it 1 or 2 more minutes, let us know where you're tuning in from. We'd love to see where you guys are watching from. That'd be great. And by the way, guys, you do not need to sign up for the YouTube membership to watch this. That is basically a special membership that allows you to watch podcasts and interviews early. So if you're interested in that, you can click the join button. But otherwise, this is completely free. No need to sign up for anything. And again, just our goal here is to present and help you build a trading system. That's our #1 goal. Awesome. So we've got Qatar, Utah, India, Romania, Germany, London, spell with the U, España, very nice, Germany, Philippines, I love Germany, interesting, Sweden, England, Dubai, Toronto, very nice, very nice, Virginia, nice, Omaha, Canada, we got Buffett in here, hey Ishan, I also wish I've got a Rise brain, by the way, South Carolina, Colombia, India, Dominican Republic, very nice guys, awesome, and you guys can hear me clearly, just want to double check that, drop a 1. And throughout, if there's any audio issues, let us know in the chat. If you'd like me to boost my volume, I can do that. If you'd like me to boost Rise volume, we can do that as well. All right. Not very loud. All right, I'll put my volume up a little bit. Hopefully that's a little bit better.
Yeah, let me know on mine as well. We got to match them
Yep.
so it's not annoying for
I think
people.
that's better now.
Here,
Yep.
perfect.
All right. Okay. So let's go ahead and get started. Welcome to the next Trader's Handbook webinar. Super excited to have you guys here. This is going to be an excellent one. We've already done 3 that kind of lay that foundation. We've talked about key principles, common trading problems, really kind of our philosophy that everything is built upon. Then we provided kind of a foundation with regards to technical analysis, how we interpret charts. And the last 2 webinars, or the last webinar, we dove deep into setups and edges, gave the specifics ones we use, as well as just kind of provided a framework to think about how you look at setups and edges so you can apply it to your own personal style of trading. Because again, we're using our style as an example, but the frameworks that we're presenting can apply to mean reversion trading. They can apply to day trading, whatever your style is. You'll be able to apply the concepts that we're talking about to yours specifically. Today, we're going to dive deeper into the entry side of trading, focusing on entry tactics and trade execution. This is going to be an excellent one. It's the most slides we've had, so make sure you stick around until the end. We've also got some giveaways and surprises in there for you, and we're going to cover a lot today, so make sure you stick around. And if you do enjoy this, please go ahead and leave a like on the video. It really helps us out, and if you're not already subscribed, definitely go ahead and do that. And before we get into it, if you're not already a part of the Trader's Handbook waitlist, please go ahead and register. We'll be giving away a lot of additional exclusive bonuses, such as educational articles. I'll be sending one later today on a specific entry tactic that we'll be talking about in today's webinar. So if you're not already a part of that, definitely join right here. Here's a quick preview of what you get. We've already sent model book chapter preview, a bunch of other educational articles that dive a little bit deeper into what we talk about in the webinars. And if you sign up, don't feel like you're missing out, because you'll be sent these ones that we've already sent out after you sign up. So definitely go ahead and register here. Again, this is completely free. You can just scan this QR code right here and join this list. And, you know, I'm really looking forward to continuing to send out educational articles. Again, I'll be sending out one later today to everybody who registers and joins this list. We'll also be giving away a lot of stuff, including a trade analytics log later on. So you don't want to miss that. So go ahead and join this waitlist, especially if you're watching this recording. All right. let's dive deep into chapter 5. The subject of today's webinar covers what we cover in the Trader's Handbook, chapter 5, entry tactics and trade execution, getting really into the nitty gritty about how we actually enter orders after we've identified a promising stock based on edges and setups. This is kind of the last layer to actually entering a position. And I want to start out with this quote that I think puts everything in perspective, right? Because we're going to be focusing on a zoomed in view today about how you actually enter and manage orders and all that. But without the larger context, the setup, the edges, the market context, which we'll get into a dedicated webinar, the entry tactic is just the last piece that in isolation is not effective. So everything has to come together, and we'll talk about context quite a bit in today's webinar. But the quote is from Sun Tzu: strategy without tactics is the slowest route to victory. Tactics without strategy is the noise before defeat. So a lot about what we're talking today about is, specific patterns, short-term patterns, but you can always find those patterns. And the reason that they're effective when they are is because they're used in conjunction with a promising stock, showing a lot of edges in an overall larger context that's constructive, showing accumulation, and has a strong setup. So we always want to think about edges, setup, and then entry tactics is kind of the last piece of the puzzle. So here's the agenda for today. You can see we've got a lot to cover, and this is going to be a really, really good one, guys. First, getting into key components of an entry tactic, then talking a little bit about risk management, although we'll expand on that quite a bit in the next webinar, which is completely dedicated to stop losses, setting them, all that, so stay tuned for that. But we talk a little bit about tight and logical stops here, then pairing entry tactics with setups, which ones we use with which setup that we talked about in the previous webinar. We'll talk about the key level reclaim entry tactic, the consolidation, pivot / range breakout entry tactic, the 4 ways to trade ranges. Then we'll talk about key level pullbacks, oops reversals, opening range breakouts, intraday base breakouts, high volume close pivots, volume support, and then overall the trade execution process, how we think about, getting ready to actually enter an order. So this is going to be really, really good. Hopefully you guys are really interested in this. So let's go ahead and dive right in. All right. So what is an entry tactic? Like I said before, entry tactics are the final layer. They're the last piece of the puzzle after identifying a strong stock with edges and setups. They basically allow us to control risk tightly and position size adequately by helping traders enter positions with precise stop levels and risk control. Like I said, they enable proper position sizing, allow us to actually, turn the needle when a trade moves in our favor, and well-timed entries allow us to put on enough size while managing risk to actually make a difference in our accounts, and that's what leads to performance at the end of the day. Then entry tactics are execution focused. There's a clear buy point called the pivot point. There's a clear level to manage risk. I know a lot of you guys, have a question: where do you place stop losses? This today will answer that question. With every entry tactic, we'll talk about exactly where we place a stop loss and different variations as well, as depending on the situation. So like I said, the entry tactic is the last piece of the puzzle. First comes the edges, how we get a stock on our radar, how we identify high potential. Next comes the overall setup. This could be a base, this could be a gapper, whatever the larger pattern that you like to trade and you've studied historically and is effective overall and shows up again and again in the biggest winners. That is the larger setup. Then the entry tactic is the specific buy point, the smaller pattern. And in this case, we've got an example of a consolidation pivot, the smaller pattern that completes the setup and allows us to manage risk tightly at a higher low, at the low of the day, at a moving average. This is the last piece of the puzzle after we've identified a strong stock with edges, and it is basically exhibiting a larger pattern called the setup. This is the last piece of the puzzle that allows us to actually enter and jump on a trend and, participate in a strong move. So let's get into the key components of an entry tactic. Like I said, basically there's 2 different parts. There's the pivot point, the actual entry area, and then there's where you place a stop. And both of these work together to define the risk we take on a particular trade. So if you think about this, this is your buy point, this is your cost, and then the difference, the distance between your cost basis and your stop defines the potential risk that you have. And then this dollar risk multiplied by your position size is your overall risk on that position. So this amount, this distance, is something that we can set. We can choose where we enter, we can choose where we place our stop, and we can also choose our position sizing. And that is what allows us to specifically define our risk. And we'll get into this, like I said, quite a bit in the next webinar and really get into the math behind it as well. But one thing I want to emphasize just in this webinar,
Richard, before we can
yeah,
before we continue, just turn up your volume a little bit. It's been a
yep,
consistent comment.
there we go. That should be a little bit bigger. All right,
Yeah.
cool. So before we get into it, I just want to emphasize this concept of tight and logical stop losses, and this is something I learned from Ross Haber. He preaches this over and over. It's a fantastic way to think about it. Basically, and I'll define what tight and logical means. We're looking to enter at a spot where we can manage risk tightly as well as logically, meaning that the percentage stop is pretty small, and we're managing risk and placing our stop loss at a logical place based on market structure based on a moving average. Basically, if the stock hits our stop, it's a logical spot that defines that the entry tactic that we're using or the setup we're using has failed. And I think this is a great quote from William O'Neill, just stressing the importance of placing stop losses. Buying a stock without knowing when or why you should sell it is like buying a car with no brakes or being in a boat with no life preservers, or taking flying lessons that teach you how to take off but not how to land. And every single market wizard, William O'Neill included, just stresses the importance over and over of managing risk, and the entry tactics, buying right, what we're presenting in this webinar is really how we are able to manage risk in real time, set our risk, all of that. So this is a really, really important quote. All right. So getting a little bit deeper into tight and logical stop loss, just to put it into perspective before we dive into the entry tactics. Tight and logical basically means that entry tactics must allow for a tight and logical stop. Logical means a violation would signal the setup / entry tactic has failed. So if we enter here and we break below the stop, that means that this higher low has been violated. This pivot breakout has failed. And we've seen a reversal down. However it breaks, that would basically signal that it has failed. Logical basically means that a violation would, oh yeah, sorry, I put that part. Tight basically means that the stop will limit losses to just a few percent. And if you can't set such a stop, I think this is really important. There isn't a setup. Wait and be patient. I want to repeat that again. Let me
We lost your screen.
yeah, let me join back again here.
Yeah. Cool. I'm all big on the stream now. Just give us a
Yeah,
few
sorry about those guys. We'll be right
seconds.
back.
In the meantime, if you guys have any questions about entry tactics and what we covered, you can place them in the chat here. I'll take a look and see if we can answer some questions.
Yeah, hey handsome.
Smile, right? My face is like this big now.
Yeah, bear with us guys. Why is bro representing your end?
Lots of energy as usual. Yeah, YouTube is placing ads. We'll likely turn those off on the live stream. That's our bad. We likely forgot to.
Yeah. And maybe you could.
That is me shaving, by the way.
Yeah.
So.
All right. Give me 1 second, guys.
What's your process of calculating how many shares to buy in the heat of the moment? That's a good point. In the heat of the moment, I think traders should not be calculating or making, you want your decision-making process to have the least amount of layers. So if a stock and that you're interested in the $1.50 buy point or something like that, and that stock gets above 50, and after that you're starting to look into, where do I place my stock? Where do I place how much is my risk? How much should I be buying? What is my position size? You're already you've detached yourself from the process, right? Like you've added 5 layers of decision making for you to press that buy button. So all of that, the sequence of making, whatever leads to pressing that buy button, position sizing, entry tactic, where your stop loss should be, is it a good stock or a bad stock? That should all be moved offline. That should not be real time, right? That should be done when the market is mostly closed. That's how I found a lot of success, is to not, put myself in a position to make those decisions while the ticks are moving up and down. It creates a lot of chaos, and it creates a lot of bad decisions, basically. So we'll speak to that in terms of how you position size in future webinars. But I think, your preparation has to be offline, not real time, essentially.
Yep.
Richard, we could continue.
Yeah,
I think
sorry
the
about that,
screen's back.
guys. I don't know why Zoom failed us, but we're back. All right, I'll restart this slide. So, what does tight and logical stop loss mean? Again, entry tactics must be tight and logical for it to be a valid entry tactic. Logical means that a violation would signal that the setup slash entry tactic has failed. Again, if we enter through this pivot point and we start to move up, then reverse down. I'm sure all of you guys watching this have experienced that at some point, and we violate this stop, that basically tells us that this entry has been invalidated. We've undercut the higher low where we place our stop, and we have to wait for the next setup, the next entry tactic, to potentially revisit the stock. Tight means that this distance is just a few percent. And this is important because it allows us to, not lose too much when we do experience a stop, which we experience stops all the time, about 50% or even more. Many of the market wizards have about 40% win rates. So 6 out of 10 times they're experiencing losses just like this. And keeping those 6 out of 10 times small is the key to performance over the long term. So that's what's so important. So that's what technological stop loss is. And again, we'll dive deeper into that in the next webinar. All right. And I think this is a really good metaphor that the last time we did this with the Ultimate Trading Guide, a lot of people it seemed like this resonated with a lot of people. Stop losses are simply the cost of doing business in the market. They're essential for longevity, to be able to do this for decades. They help, get you out of bad markets and corrections like the one we're experiencing currently. And again, they're simply the cost of doing business. And what I want you to think about is every trade you take is like a ferry ride. I'm in Seattle. We take ferries all the time to different islands and all that. It's awesome. And your stop loss is basically your ticket fare to ride that trade, to jump on that ship. And sometimes you even get to keep it. You get this, the trade works for you and you get your money back. And you actually get to decide how much your stop is. You get to decide how much you're willing to pay to try that trade. And we define that amount by our entry tactic, by the distance between our cost basis and our stop loss. So all in all, don't fear stops, thank them. They protect you, they allow you to keep trading for decades and experience that compounding over time. And any experienced trader will tell you that the number one rule is to cut losses short and let your winners run. Cut your losses short. You've heard that a million times, but there's a reason that's repeated over and over again. It's because it's one of the core truths of trading is unless you cut your losers short, you're going to experience bad losses that set you back weeks, months, even years sometimes. So this is really, really important. And, we can't predict the outcome of a trade, but we can decide how much to pay to try it. Again, we can decide how much our ticket is going to cost, how much our stop loss is. We can define that risk very concretely, and entry tactics allow us to define our stop clearly at the low of the day, the higher low, the key level, whatever it is. But I think what's really important is that your stop loss, just think of it as a ticket, and you can set how much that ticket costs to actually try that trade. Right, anything you want to add on kind of this way of thinking about things, or just how you think about stop losses and their importance in general?
I think they should be respected as a trader. We let our egos get in the way, and when we plan out a stop and it hits, you just have to take that, learn from it, and move to the next trade. What's bad, or what, a lot of new traders and phase one and phase two traders put themselves in, is they don't respect the plan that they put forth, and that's really what hurts them in the long run, right? When you're taking a swing trade and a position trade with a 4 to 8% stop loss, and or in that range, depending on your style, when that hits, you have to take the loss and you have to move on. And that's just the reality of trading. There's no absolutes. Uh, and there's no, I would say, guarantees that any particular setup, any particular edge will work, more 100% of the time. So recent example of a trader that I spoke to, is they purchased Tesla right around the $400, level, and that was a major support in their opinion. They planned that trade out, and it broke their stop loss, and now it's down, 40% from $400. and that trader is still holding on to it because he took a swing trade or a position trade at a level of support or a key level that he determined on the charts, but then he failed to respect his stop loss. That results in huge drawdowns in your account. And that's really the difference between a consistent trader takes losses consistently when a stock comes in and hits their stop, or takes, profits consistently. That's what we spoke about in the first two webinars in the consistency phase. So that's really what separates the two type of traders that we always speak about, the boom and bust and the consistent trader, right? So yes, you're going to have losses. You have to, you're going to lose. You're going to have more losing trades than winning trades in your trading journey. But what will happen is your winners will be far greater in terms of percentages. So taking those small losses along the way will be very, very easy. It should be very, very easy to do, right? If you look at the um,
long term.
the long term in your trading
Yeah, and I
journey.
really like another analogy that Yen in the chat said. If you get on the wrong train, get off at the next station. The longer you stay, the more expensive the return trip will be. Exactly, and losses work geometrically against you. You've all seen those charts where if you lose 10%, it's about 11% to get back to break even. But losing much more than that, losing 50% requires a double to get back to break even. So we want to keep it as tight as possible. I like to keep it around 3 to 4%. Rye, I know you keep it even tighter than that with your entries. And again, we'll get into stop losses and really specifics in the next webinar. But yeah,
Yeah, and also one thing I say is, corrections in the market are built to turn a swing trader into an investor and an investor into a long-term investor, right? So that's a mechanism of not respecting your stop losses. You have to respect them. If you planned and you follow your plan consistently, you'll be a better trader because of it. And if you continue to ignore them, then you just become a bag holder in stocks, and now you're part of companies that are down 80, 90 percent from their highs, and they will come back. Maybe they will come back in 3 to 4 years, but you're now detached from your objective of being a swinger position trader. Let's keep
perfect.
going.
Yeah, so diving into the meat of today's webinar, let's talk about entry tactics finally. So I think the big high level thing that we want to talk about here is context and confluence. We've talked about how context is so important. Entry tactics can't be used in isolation. They have to be in a strong stock. They have to be in an overall mature setup, like a base, like a gapper, whatever it is. That's really when they work best. You want to stack the odds in your favor, and a big part of that is looking for confluences. Here in the diagram here, we've got an example of a base after a strong uptrend. We've got a moving average here, a representation of moving average, and this entry right here coincides with the reclaim of the moving average, as well as this pivot here. And this is the type of thing we want to be looking for, or on a pullback by, pulling into the moving average as well as this prior pivot. Whenever there's stuff like that in the market, more participants are going to support the stock and buy the stock at that level. And that's what allows us to increase our probabilities and gain confidence in the setup. And one thing that I do want to emphasize here is today, especially as we get into some of the gapper setups and entry tactics, we will be talking a little bit about some intraday setups. But I think I want to be really clear here. Unless a stock is set up on a daily and weekly chart, there's no point in looking for an entry tactic or entry on an intraday time frame. You can always find entries on an intraday time frame, but the ones that actually work are because the stock is set up and under accumulation and set up on the daily and weekly chart. So don't lose, don't look at the trees and not see the forest, whatever that saying is. Focus on the overall the context and make sure that the stock is set up on all time frames if you're going to be looking at intraday. I think too many beginning traders, say, oh, I can manage risk tightly on a 5 minute, but the stock has to be set up on a daily. It has to be set up on a weekly chart for a stock to actually make a meaningful move. So that's really, really important. All right, so let's get into it. So we talked about three main setups in the previous webinar. If you haven't yet, check the link in the description. We'll be posting the playlist to the previous webinars. But there's three main setups we talked about: the gapper, base breakout, and launch pad. each has their own associated entry tactics. There's some crossover because you can use a range breakout after a base breakout. You can use a range breakout after a gap. But, in general, these are kind of the entry tactics we'll be talking about related to a gapper, and these are the ones related to the launch pad. So this is kind of how everything's interchanged. So for base breakouts and launch pads, they're both kind of overall base patterns that are forming up. We look for key level reclaims, consolidation pivots / range breakouts, key level pullbacks, as well as oops reversals. Then for gappers, we're looking for on day one, opening range breakouts and intraday basis. We've got a bonus tactic there that you'll have to stick around to see what it is. And then, after day one, and day one is the day of the gap for everybody. After day one, there's other entry tactics that we can use, like volume support, high volume close pivot, as well as a range breakout after day one of the gap. And I want to be clear, we're going to talk about some intraday setups on day one, but to have success with a gapper setup, you don't need to trade day one. Often, you can kind of see the cards at the poker table before you decide to enter by waiting for day one, screening for day one, and then looking for an entry tactic that we talk about right here after the fact. Huge gaps on big volume are often the start of longer term trends. So don't feel like you need to rush and get into day one if that's scary for you or you don't feel like you can manage risk. You can always use these other entry tactics that we'll focus on to enter after that day one move. So this is kind of just setting the overall context, and we'll start with talking about these right here.
Yeah. Richard, turn the volume up a little more.
Okay.
When you're done.
Yep, that's up a little bit more. Okay. So before we get into that, just on the very short term, we're going to be talking about ranges, which can be 3 to 4 days or as short as 2 days. These are just some priming short-term patterns that we talked about in the technical analysis foundations that, are useful to know because they set clear pivots that we'll discuss later on. So we've got the inside bar where all the price action is contained within the previous bar. This high is a breakout of this consolidation on a very short-term basis. Then we've got the upside reversal, and this could be where it opens here, pushes under the low the previous day and closes strong, or like here, which is actually an oops reversal. We open below the low and close strongly, and then follow through the high is another potential pivot point. And then here, the last short-term pattern that kind of primes a mature setup is this positive expectation breaker where we have a very negative close and we gap up and close strongly, and these highs can be that pivot point. So these just kind of set pivots within the context of the entry tactics we'll talk about today. And you'll see these all over the charts right before a stock makes a strong momentum move. So that's why we want to present these and keep these in mind as we go through the examples today. All right, but let's get into the first entry tactic that we'll be discussing, and that is a key level reclaim. And a key level could be a prior base pivot. It could be, a key low, like with this example, or it could be a moving average. There's some dynamic at work here where there's basically a key level that a lot of market participants are watching, whether that's the 50 SMA, whether that's the 200 SMA, where, like we said, there's a prior swing low that's very obvious. We're looking for a clear potential support level that gets undercut and then gets reclaimed. That's what we're looking for here. And you've got an entry as it reclaims the key level, and your stop would be under the higher low right before that reclaim. And here's basically the same example with a moving average where we reclaim it. This is the entry point, and then your stop would be right under the higher low right there. So here's an example with Uber back last year. We have a prior base low where everybody thinks this is the key level and the stock is bottom. It starts to move up, gets rejected down, moves down again. It's respected once. So you're seeing prior respect for this level here, here, and here. And then what happens? We lose it. Everybody who used this low as a stop got shaken out, and we push lower, and it looks like we're going to test the 200-day moving average. What happens though? We get a positive expectation breaker where instead of following through from this bar, we gap up and hold, and then we start rallying back through that level, and that is the entry point, and your stop would be right under this low, or even the low as it pushes through. We get a gap up and a strong trend, and finally a breakout here. So this often happens actually right before the stock is ready to move up the right-hand side of the overall base. This is a really good example of a base pivot, or actually a base low that gets reclaimed, and then we're off to the races and enter. So this is kind of a key level reclaim, and we've got an example here with a moving average. This is Reddit, where we're in a consolidation in a base. The 50 SMA is above the stock. We see it be rejected once, and we actually pop through it, retest it, and then close strong. This is the 50 SMA reclaim right here, and we're off to the races. And we know that Reddit did tremendously well from this buy point. We also get a reclaim of the 21 EMA here, but that's a little bit more advanced. And in general, for bases, 50 SMA reclaim is a little bit more significant. So that's an example with a moving average, and this allows you to manage risk right at this low or at this higher low as well after it pops through. I like this one here because I like my stops a little bit tighter, and to me, if we pop through the 50 SMA, retest it, and then close strong, it should not violate this low and close below the moving average again, and it should just be off to the races as it did. The best stocks just go after a successful entry tactic, and that's something that you really want to look for. Let's see. Ryan, anything you want to add about a key level reclaim, both with a level or a moving average?
I think the key moving average, the 50-day, is one that's used by a lot of traders, and there's a lot of eyes on that moving average. So it's a key level, just like the 200-day when we go into a deeper correction. A lot of the eyes from an index perspective go to the 200. These are important levels in the market. There are a lot of traders and a lot of folks watching these. So when they are reclaimed, it creates instant momentum to the upside, or at least a level for you to consistently
Yep.
watch. The example, that I see on it with the Reddit, if you go back to
Yep.
that, is if I draw on here, they're going to see it, right?
Yep. Yeah, I was going to point
So
that out.
this is kind of your horizontal resistance area, right? If we were
So there's
to
confluence.
look at, yeah, so stands, always looking for that, the stock is in a downtrend, now it's going sideways, and now it's built this horizontal resistance area, and then that's a confluence of the 50-day as well. Now you have two factors going at once. One is the stock is having a tough time to go through this particular level on the chart. Second is that the 50-day has now flattened, which means for the last 50 days, the stock is now consolidated and built out a sideways base, right? Those two things, and what happens essentially is when we pop through that 50, is that multiple styles or multiple folks that are looking at technical analysis in a different way, plus just the 50-day being a key level in the market for a stock that is super liquid, right? And a younger company. It's also, again, showing relative strength, right? It's outperforming the market within this consolidation. All these factors, when they come into play and it breaks that, the really key part to that is what Richard said. There's no reason for this stock to come back and violate this low. That that is what an entry tactic is. It gives you an entry, but you know your stop loss. If this stock were to come the next day, let's just say hypothetically none of this happened, right? Up here, and next day just came in and broke that, at least you know exactly where you're going to get stopped out, right? And if that happened, you take that loss and you move on to the next set up and look for that formation to form again. Over a span of trades, regardless of what the name is on the stock, Reddit, Meta, Uber, doesn't matter. This type of formation will play out. And not every formation, let's say if that one out of, 3 out of 10 fail like that, if the rest of them work, you're just going to have asymmetry in terms of your performance in the markets. The key here is a lot of traders struggle with the fact that what makes this entry point really, really good right here is the fact that you know your stop loss and you know that the stock should not, if it's a leader and it's about to run, it should not violate this
Right.
area. That's the most important.
And one thing I want to add, because I saw a question, why this reclaim versus this reclaim? And that's a really good question. The reason being is going into this level, we've already expended some energy moving up off the base low. Not too much, but you've already run quite a bit as you're approaching this horizontal line of confluence, as well as the declining and pretty sharply declining 50 SMA here, or relatively sharply declining here. And you could try this and your stop will be at the low, and the next day you get taken out, and that's just a stop hit. So this entry is a little bit better. This entry isn't terrible, but you get out with a small loss, and that's trading sometimes. And I really like how after it failed, what did we do? We pulled in on lower volume into the 21 EMA were supported, had an upside reversal. Remember the priming patterns that I talked about. And then the next day we get the better entry tactic. So even this one, even if you tried it and failed, you don't want to be discouraged, and you want to keep an eye on the stock because it actually set up even better right here, as we're talking about with the 50 SMA reclaim. So I think this is a really good example where, again, the entry tactic and the stop would be the low of the day, because if it violates that, it looks like another failed breakout right here. So this is a great example with Reddit, and definitely one to study. Right, any last bits you want to add on a key level reclaim?
Nope.
All right, cool. The next one is going to be a buy on strength, and it's a consolidation pivot / a range breakout. And consolidation pivots are basically key pivots and ranges that form up the right-hand side of a mature base. You've got the traditional base pivot up here. These pivots are smaller in nature. These ranges are going to be smaller than the overall base, but they're clear lines of resistance up the right-hand side. And your stop loss is either going to be set at the low of the day as we break through, or at the previous higher low. So that's how you can think about it. And you can see how we get a range breakout, pull back into the range, and then re-breakout. This happens quite a bit, as well as sometimes this next one is a pull into a moving average. And again, moving average reclaims might be confluence with this first consolidation pivot breakout. So let's get into some examples. This is Shop way back when it was a recent IPO. It's in an overall basing pattern. It's a recent IPO. That's one edge to look for. It's been showing relative strength. So again, that's how we get the stock on our radar. We're not just looking at this entry tactic in isolation. We're looking for edges, and then we're looking for an overall setup, and then we're looking for a tight area. And this is the consolidation pivot right here. You can see we moved off the base low, went tight for about four bars, 5 bars. This high becomes the clear line of resistance, and we get a clear breakout, pick up in volume as we push higher. This is before the base pivot, so that's why this is called a consolidation pivot breakout. And we actually consolidate right on the base pivot and then keep going. And this one, I think, doubled or tripled from this point over the next year, and then I think even more so, over the next 5 years or so, of course, as we know. And one thing I want to be clear here is, in addition to the relative strength, you've got tightness at the bottom of this base. You've got this positive expectation breaker. There are signs of accumulation within the space, and that's what I'm always looking for before I'm looking for an entry, before I'm looking to use an entry tactic. I'm looking for signs of accumulation, tightness at the bottom of bases, strong moves. You've got this subtle gap here, which Stan Weinstein always looks for, up the right-hand side of the base, and then we go quiet and tight on a decline in volume. Again, a winning characteristic that we talked about in the previous webinar as the one before that. And this range is only about 3-4%, and we get a clear breakout on a pickup in volume. And this is the entry point right here. This is Ross Haber's bread and butter setup. And this is one I use quite a bit as well. This is kind of my preferred entry point for a promising leader. And it's really, really effective and shows up again and again if you study winners. There's always a consolidation pivot breakout up the right-hand side of a base. Here's another example with RKLB from the previous year. So again, we're showing stuff from like 2017. We're showing stuff from last year. This appears over and over again if you go back and study previous winners. These are a little bit more subtle, and this is why we're doing this webinar, to help you spot them. And here we've got a larger basing pattern. I don't show the horizontal line, the pivot right here, but this is resistance, and this is overall a base. And you've got mini consolidations within this base. And then the consolidation pivots actually are very subtle here, where you've got just 2 days of tightness, 3 days of tightness, 3 days of tightness right here. And the pivot is this key resistance level where you've got the high of the range. And this is RMV down below. This is just highlighting that tightness for you. And whenever RMV goes to 0, I look for a tight area right here, right near the highs. That's my consolidation pivot buy point. And you can buy here, expansion, contraction, expansion, contraction, expansion. So these range breakouts are allowing you to buy when a stock is coiled within an overall setup and participate on the momentum moves higher. That gives us immediate profits, allows us to jump on a trend. If you're a swing trader, you're selling into strength. And if you're a position trader, you're riding along for the ride and trying to hold as the stock keeps trending above the moving averages. But consolidation pivots, whether they're 5 days, 4 days here, or I want to show this example because you've got just 2 days, 3 days, 3 days here, they can be pretty tight. And the tighter the better. You've got inside days, upside reversals, tight closes within them. That's what makes the best consolidation pivot breakouts. We've got another example. This is NVIDIA back in 2021, I believe. You've got two bases here, one here, basically stacked on top of it. And let me actually zoom in here so you can show it a little bit clearly. Let's focus on this base for the time being. We've got a pullback below the moving averages. We've got a very negative day. The expectation after this bar is fall through to the downside. What do we get? We get a positive expectation breaker. I'm telling you, if you study bases, these positive expectation breakers happen all the time at the bottom of bases as well as up the right-hand side. We get a move up into the moving averages. We get rejected. This is classic. We form an overall mini base within this overall base. And then we get 2 days, around 3 days of tightness where these highs line up. And this is your consolidation pivot. Again, a pretty subtle one. But this is your consolidation pivot. It lines up with a reclaim of the 21 EMA. You're buying through this high, setting your stop at the low of the day, very tight, or even the low of this prior day, which lines up with the 200-day moving average, still within a few percent. And then we move up, expansion, contraction again. You're buying this outside day through these highs, adding to your position or building it up. Expand a little bit, go tight again for 2 days on a decline in volume, very low volume during these tight areas. And then we expand again on big volume, and you could buy again through here, fill out your position even before the base breakout. Going into this next base, we get another pullback below the 21 EMA, another pullback below the 50 SMA. Again, we respect the 200 SMA. We get a nice big reversal up off lows, and these highs line up to form the next consolidation pivot off these lows. We get a break through that, expansion higher, another consolidation right here. This is the pivot through these highs. So again, that's how I'm spying these. I'm looking for ranges. I'm looking for where highs line up, and that's where I'm drawing these lines. And you're buying the breakouts through that before the overall base pivot, and then you're off to the races. And NVIDIA had a nice, I think, 50%, 40% move from this base breakout. So that's a little bit about the range breakout. Rye, I know you kind of add to your position on these, but anything you want to add, maybe talk about looking for relative strength phase and then the first contraction. That might be a useful bit of advice for everybody.
Yeah, so like we spoke about in previous webinars, for me, it's, as the pattern builds out, I want to have it on my radar. The more I learn how a stock trades, the more I can focus in on it. And essentially for me, like somewhere around here would be, the stock is outperforming the markets clearly. So the relative strength line is above its 21-day average, and it's outperforming the markets over a span of 21 days, right? We've built out a base and a consolidation. One of the things I'm looking for right around this area is tightness and price action, which, now with RMV, it makes it a lot easier to spot on the charts on a relative basis, right? So we have relative tightness, we have a stock outperforming. The next thing is the theme. The semi theme in the markets has always, over the past couple of years been the primary leader. And nothing really gets better than this. The stock is super liquid, right? It trades really well. I can buy a lot of this stock and, not influence price or worry about if this doesn't work out, what happens. And then the most important part is when I am getting involved, my stop loss should be known. And I try to operate within the 3-4% range because I am a momentum trader, primarily a swing trader. I want a stock to move up after I buy it. And I don't feel the need to, sit here and start to be an investor all of a sudden because that's not my objective or my goal when I'm trading the markets. So, the RMV, the relative strength phase, where it's outperforming the theme in the markets, when you put those things together and then you start tracking that, hey, let's say the market here was in a correction, right? And I expected NVIDIA to have a deeper base. It doesn't. That right off the bat, you start tracking, base depth. Why is it not moving much lower, compared to the markets? Why is it starting to outperform? It's, the primary leader in the market as well. And I know that I can have a definitive stop loss right here and have very minimal risk with very large position sizing to hopefully, not all of them work out this way where they all just, place a trade and then they never look back. They frustrate you a little bit more. Oftentimes you're likely getting stopped out more. In terms of number of trades that are winning or losing, you'll likely have more losing trades in the market than winning, but your winners will do this instead. So that's, the elements that I'm looking at when I'm looking at, tight consolidation areas. RMV is something I think, everybody should look at. If you're trading tight price action, tight formations, it allows you to define risk really, really well. It's telling you that the stock is now tightened up. The best thing is when it's tightened up and it has, dry up in volume where Nvidia didn't have, that big of a dry up. It was just that one day where it moved down and the volume was low. But if it had this was a shallower dry up, I would have even more conviction. Couple of more examples like this come to mind. Tesla has done this many, many times where it goes sideways, sideways, sideways. Roku, before couple years earlier, right around that 100 level, it just consolidated with tightness in it, and then it just blew that level and never looked back for a couple of months as well. So a lot of this happens in the markets again and again, but you want to look at different confluences of, is it outperforming? Is it part of a leadership group? Is the RMV near that zero, confirming, data-based tightness that you take all those and then you make a trade
Yep.
uh, on the stock.
Perfect. Yeah, and even though volume wasn't super below the average, it was declining considerably since this move up. And this is just super tight price action, within 2-3%. And RMV again, we've done webinars completely on this indicator. You can search that if you'd like. But when this goes to zero, it's showing that price is tight, just like this. What do we see at the right hand side here again? Tight price action when we've got this really tight range here. Tight price action when we've got this tight range here. So it's showing that subtle tight areas that market wizards look for, but newer traders still haven't quite trained their eye for. So it's just a helpful indicator to identify objective relative tightness. All right. So we've talked a lot about consolidation pivots and ranges and buying them, but how do we actually trade ranges? And I wanted to go through kind of 4 different frameworks that you can use to trade those ranges slash tight areas. So something like this, something like here, something like here, where you've got a clear range for at least 2, 3, ideally 4 or 5 days, just like this. So think about when I show this, think about placing that range up the right hand side of a base. So this is what we're talking about when we're talking about trading a range. So let's get into it. First, and we'll go through in detail each of these, you can accumulate versus lows, where you're kind of buying versus the low of that range. And again, this could be like a daily chart where it shows this happens over the course of many days, where each time it's pulling into the same overall level, gets supported, it's being accumulated. You can buy versus that low, set your stop loss right under those lows. So, if it violates that, over time on a closing basis, you're out with a small loss, but you've got a great cost basis if it does break out of that range. Next, we've got buying tightness, anticipation. As it looks to be breaking out of that range and sets up a higher low, then you could enter setting your stop right under that higher low or even the low of that range. That would be a great way to, again, get a really good cost basis with a very tight stop. The third way is kind of my favorite, an undercut and rally, where there's a mature range of a few days. Then we get maybe a gap down in the market or just a big shakeout below that range, and we rally back through that level. It's kind of like that key level reclaim, but on a much smaller time frame. And you can enter versus as we reclaim that level and even add on as we actually break out through that range. Then lastly, we've got the standard range breakout. This is probably what you guys are most familiar with, where just we break out through key highs and we enter here, saying our stop at the higher low or the low of the range. And you can even add at the next, slight higher low and re-breakout, confirming the breakout of the range. So those are at very high level are the 4 ways to trade a range. So again, this is how you accumulate versus lows, where the stock has pushed up off the low of a base. It's formed 1, 2, 3, 4, or 5 days of tightness, and it keeps respecting a key level. And this could be, a whole number rye. I know you want to talk about that a little bit. This could be right above a moving average as well. There's often confluence there. But the key thing is that this range keeps respecting a key level in the market, and that is the bottom of the range. And you can enter as it keeps confirming up off that level, setting your stop and buying as close to that level as possible. So if you're right, no harm done. You're down very, very minimal amount. And if you're right and we break out from that range, you've got a really good cost basis, managing risk versus that level right here, and you're off to the races if we keep moving higher. Ryan, do you want to talk about kind of how you buy? Because I know you like to buy this way versus the level quite a bit.
Yeah, I pick a level. I mean, the way I look at the markets is if I'm looking at Reddit, for example, which was a trade last year, or A-Lab, I pick, if it's a clear level on the charts, let's say 60 on Reddit, right? Or when it's coming in, it's respecting, the 55 area quite a bit. So that makes it easy for me to track. If we say this is, 55 and this is 60, and the stock on the down days in the market is continuously, holding this 55 level, it allows me to accumulate that stock, within that 1 to 3% range. If it's away from that 55, I can continue to, buy it here. Rallies, comes back in, buy it again, right? But if it violates that level in the, that 55 level, then I'll be out while keeping my risk in that 1 to 3% range. Now, why would I buy a stock that is pulling back and not breaking out? That's a common question. So as a base builds out, what happens is if a, let's say the market itself is pulling in quite a bit, but the stock continues to respect the level, which let's say is 55 in this case, that's relative strength versus a particular level that I'm interested in. And as long as I can operate within that 1 to 3% or 3 to 4% stop loss range or risk, then I can, continue to accumulate the stock. And what I call that is relative strength versus a level.
Hmm.
What happens is the relative strength line will continue to rise to the upside while the stock continues to respect that 55 hypothetical level that we're speaking of, and the market's pulling back in. So the RS line is rising. The stock wants to outperform the markets. There's market pressure that continues to, push it back right into that level, and it continues to respect and hold that level and not break it. When all those elements combined, take place, what happens is, you can define your risk really, really well. Eventually, what happens is that top side pivot, which is let's say at 60, becomes your secondary or your third or your final buy
Hmm.
point, right? And when the market pressure lifts, and the market's fine, the relative strength line will also go up. And what you would ideally want the stock to do is also rip to the upside while breaking your secondary or your tertiary entry area on the top side. So I hope that makes sense. I love doing this when you track bases and your bigger bases on the daily charts or the weekly charts. It's the same thing. You'll see the structure of a base will always tend to respect some sort of whole number in the markets, be it 30, 40, 50. And that could be a really easy way for, Nvidia is holding 100, or Google is holding that, or CELH, when it was in that uptrend, held that 30 area for about 18, it held $17.50 throughout its whole base. That allowed you to, track the stock really easily, but most importantly, define your risk and also your stop loss. That's, I think, the bigger, objective here is if I can get away with a risk of 1 to 3% or 3 to 4% in on any setup, I'm in the driver's seat and I can dictate the action because I can dictate, I know how much I'm going to lose if this were to come back in and fail on me.
Yep. Perfect. The next way is kind of a step up. So here you've been maybe accumulating versus lows, and like Rye said, you can combine different ways to trade a range to build out your position. This might be you've recognized that the range is pretty mature. It looks ready to break out. It does one last pullback, then pushes higher towards that base. You can anticipate that breakout and enter, setting your stop at the higher low. So here you would set your stop with this one. You'd set your stop at the low of the range as you accumulate here. Here you're setting your stop pretty tightly at that higher low, anticipating the breakout. And this could be kind of your second buy after maybe you've been accumulating your lows. Then the third one is a little bit different. We've been forming a range here, and then we get a shakeout below the clear low that we've been accumulating against. Maybe you're stopped out, but this shakeout provides an opportunity if we quickly reclaim this range low to enter while managing your stop at this key low here as we reclaim. And this might happen at an oops reversal, which is something we'll talk about later. But basically, you've got a clearly defined range right here. We get a shakeout lower and then a reclaim of that range low. You enter there, and then you can even enter again at the true range breakout, as we re-break out and reconfirm. But this is kind of my favorite personally, where we've got a range and it stops everybody out. And then that often leads to rapid movement to the upside if we reclaim that range low. And you can set your stop really tightly at that key low where it reversed up from as it reclaimed that level. Lastly, this yeah, go ahead.
One of the hardest things, if you just go
Yep.
back, to do is, let's say, you're trading versus this level, and you get stopped out right here, right? That's what we spoke about in the previous slide. And the fact that you get stopped out, it becomes infinitely hard to buy it back right here. It's the most uncomfortable thing that you could possibly do, because the stock that you were watching voided your thesis and said that, now wasn't the right time. And it's, buying it back right here is one of the hardest things, and it mostly comes with experience. A lot of experience and a lot of seeing the situation, right? Something made the stock really, really special in this range right here, right? And the fact that it undercut and took out a bunch of stops, but then reclaimed it, uh, you know, whatever that was special about it, is likely still special if it reclaims that area once again. It's one of the hardest things to get, around. It's tough, but watch for these situations, right? When you get stopped out of a trade, continue to track it, and if it starts working thereafter, it may just be that you were a little early to whatever, you thought, whatever you thought that made that name super special is still special when it reclaims that level, right? It's just that it took you out, and you get a little bit sour, or you start to, move on to the next stock, or you stop paying attention. And many times, me personally as well, I miss a lot of really good looking stocks where I had the right idea, I had the right, I was looking at the right stock, but what happened was I got stopped out of it, and now I don't want to buy it back, right? So that's something you have to keep in mind is, whatever made it special over here and when you were tracking it, there's nothing that's changed other than that, it stopped you out, and now you have to, figure out a way to buy it back. So,
Yep. And then the last way is just the standard range breakout, which is kind of more what we've been talking about, where we've been forming a range for a few days. You've got a clear buy point. Maybe this is the high of a day, high of the previous day. Maybe this is an inside day right here. We break out through that high, enter right there, manage risk at the low of the day or the low of the prior day, the low of the range. And then you could even add if it does another higher low. This is kind of the more standard way. And I think this one and then this one are my favorite, is the undercut buy here, and then you can even add as it breaks out through the true breakout. But this is just kind of conceptually what we're talking about when we're talking about consolidation pivots and range breakouts. Also, just to kind of lay it out there, this is where these range breakouts can happen. You can do up the right hand side of the base. You could have a range after the breakout, and you can also do it as it pulls back into a base. So there's many different places ranges can form, but they're constructive as they do. And these concepts right here allow you to trade them while managing risk at clear levels that we talked about: the low of the range, the low of the higher low, the low as it breaks lower, as it reconfirms up, and at the higher low of the day before. So that's kind of what I want to talk about here with the range breakout. All right, getting into the next entry tactic, we've got a key level pullback. And just like the key level reclaim, this can be either a moving average, it could be an anchored VWAP off the base high as well, or it could be, a prior consolidation pivot, like in this example where we've got a consolidation pivot right here, and we pull back into that area. So there's kind of a few different ways to trade versus level. And right, you kind of talked about this as you talked about trading the range, but as a stock pulls in, this is just a graphic representing that a stock's pulling into a key level that the market is aware of. Maybe that's the 50 SMA, maybe that's the anchored VWAP, maybe that's the 55 area. You could start accumulating as we get close to that level. You're expecting it to respect it. You're managing risk right at these lows right here, or just below that key level. Maybe it undercuts it a little bit, but then reclaims it and starts showing respect. This is where you can start entering versus that level. So think of this as the 50 SMA here. We pull into the 50 SMA. We bounce off it once, we undercut it. People think it's going to break through, but then the psychology flips as we reclaim that level. This would be the first potential entry, managing risk at this low right here. We reclaim it, pull back into the 50 SMA, show respect for it again, reclaim higher, form a higher low. You could enter right here and add to your position, and then re-enter as it breaks through the range off that level. You see this quite a bit against the 50 SMA, against the 21 EMA, against another key level, against a base pivot. You'll see this pattern quite a bit where we respect it once, undercut it, reclaim it, pull back into it, and then rally from it. So this is something that you can expect going forward against a key level, and a good framework to think about buying versus that level. We're not buying blindly as the stock is pulling in and we want this to be a drift lower versus a sharp drop. We're buying as it shows respect for that level and rallies off of it. That's what's really key here. And we want to manage risk against these higher lows and the key low that we bought from. Right. Anything you want to add about trading versus a key level, and kind of the framework that you use?
No, I see a lot of questions in the chat on how many days do I wait? 2, 3, 1 week? What time frame are we talking about here? I think the primary focus should be to think of what makes this a good entry and where you can place your stop loss. Is it 1 day? Is it 3 day? Do you know when it's going to break out? How do you know when it's going to break out? All of those are unknowns and they depend on the pattern that you're tracking and what you're looking at. I would just focus more with the visuals that we have more on the framework of how things are happening and how they eventually lead to a
Yep.
breakout. This is not about, I track something, it undercuts a level, I wait 45 seconds and 2 minutes later I got to buy back. That's not what we're trying to achieve here. So think of, if a stock is undercut a level and you're watching it, then it reclaims it and then it forms a tight formation. How do I buy it back? So more from a framework analytic perspective and not do I wait, 2 hours, 3 hours, 10 days, 5 days, or 1 week. I think that what we're trying to, we can't give absolutes because every stock is really different in how it trades. And the volatility of every stock is different. It's more of the framework that we're after here.
Exactly. All right, so here's again that graphic of it being a moving average. So you can think again, this being the moving average as it pulls in, that's where you're starting to accumulate. And then here, this is the pull in, you're trying to accumulate here. As the stock respects it, starts moving off of that moving average, your stop loss is right below that key low or just below the moving average. And this is again up the right-hand side of a base. Here's some examples. This is NVIDIA from last year, this really good textbook base. What I love about this is it shows a characteristic that I've really picked on recently studying different winners is when a stock is in a larger base, often it doesn't show any respect for the moving averages, the 50 SMA, 21 EMA, but as it's getting ready to break out and tightening from left to right, it starts respecting those moving averages, the 50 SMA here, the 50 SMA again here, reclaims the 21 EMA here. So when you start to see a stock respect the 50 SMA up the right-hand side of a base as it's forming a higher low versus the base low, that's when you really want to start paying attention and look to accumulate the stock. And here again, you could buy versus the 50 SMA. Again, pulling back in, you could buy. It doesn't even pull in because it's showing strength here. And naturally, the market was pulling in and it was showing RS, very subtle RS during this period. Reconfirms off of that level. That's how you kind of want to do this. Do this over time or as the stock shows respect and continues pulling in and respecting that level. Another example here is we've got App 11. Again, forms the base low here, tries to break out, pulls back into the 50 SMA. This is kind of an example of a 1 day pull back to the 50 SMA where it respects it. Have your stop at that low. If it's violated, it's going to break below the 50 SMA. It forms a tight range and then re-breaks out. And that's kind of the ideal situation where you buy a little bit early versus a level, and then you're able to participate in the breakout after it reconfirms off of that level. One more example here is we've got AMD. This is off the lows of a base where we formed this kind of gradual bottoming process. We push off the lows, pull back in on a low volume here against the 21 EMA. You'd be buying versus that level and maybe add as it reconfirms off of that level here through this high right here. And then you participate in the trend way before the base pivot. If you're waiting for this base pivot, you're asking to be shaken out because if you think about it, and this goes back to a tight and logical stop, if you're buying on this day right here, where are you putting your risk? You're way above all the moving averages. There hasn't really been much of a pause up the right-hand side. There's no real logical technical spot to clearly say the base breakout failed. So, it's much better buying versus support here, where if it breaks this key moving average, quickly that your entry tactic has failed versus buying up here when a natural pullback is, expected almost. and we actually get that back into the 10 EMA, and this would be another moving average pullback. But this buy is much better than buying this base pivot because there's a tight and logical spot to manage risk versus the moving average versus this low of the day. And here again, this key level would be where you're putting your stop loss as it pulls back into the 21 EMA. And then as we break above that level, you can move your stop up and kind of stagger it versus the 10 EMA. And we'll talk about stop loss management in the next webinar. So that's kind of the moving average versus the pullback to the moving average, right? Anything you want to add about buying versus a moving average?
No, I think this is a really good pattern. This is AMD,
Yeah.
right? Yeah, it's AMD. So this area right here that formed, if anything, a good exercise would be where can I define my risk tightly, right? And have a really logical stop loss where the pattern or the setup that I'm tracking is completely violated. It could be, this area right here. Um, as it formed, if it takes that upside, which it didn't, right? And it came down, it could be this area, but if you're tracking that below the moving averages, so likely not the best way. It's starting to form one of the setups that we spoke about right here on the right side, which is the launch pad. The moving averages are converging, which means that the stock has now been sideways for 50 days or more and has built out a really nice base. It's a 10, 21, and the 50 coming together, right? Um, and over here, your stop loss is really, really clear that if this violates that pattern and if you get involved right here, you're still in quite early and you're anticipating an eventual base breakout, right? And if it fails, it fails. You likely lose 2 to 3%. Whereas if you buy right here, everybody in the market these days is watching that base breakout. It's almost, a textbook thing to be doing to fail that initial day, to try again and fail again, because it's shaking out those folks or people that are primarily buying here, but you're also putting yourself in a really tough spot, like Richard said, because this is a normal pullback into a moving average and then get support right away to continue even higher, right? So you want to figure out those spots where you can minimize your risk, those tight areas. I'm assuming RMV, Richard, right
Yeah.
here would have been, closer to zero. So you know that from a data perspective, this is really tight. And then the second piece of information here is AMD is still outperforming the markets as it consolidates sideways. So we're in a relative strength phase. And so you have those elements, combining with the fact that when it moves above that level, it should not come back. After this particular day, it should not come back and violate this level right here. And it didn't do that. It rallied to the upside as well. So,
Yep. Excellent. All right. The next concept is the same, but versus a key level versus a moving average. So this is an example with MSTR from pretty recent days during its nice move. During this period, obviously, it's in a strong relative strength phase, and it loved to form these mini bases where it would form a consolidation pivot, pull back to it, reclaim off of it, pull back to it, move up, form another tight consolidation, pull back into it. So these pullbacks are opportunities if you miss the breakout, and almost they're better buy points because, again, you can manage risk tighter versus that level as it reconfirms up. And this one is really good. You've got confluence at the 21 EMA as well as this key consolidation pivot. It reconfirms up and is off to the races, and you don't need too much of a move in this one to make quite a bit and perform well. So this is a great example of a key level pullback to a consolidation pivot and a nice confluence with the 21 EMA here as well. This is Coinbase. So we've got a larger base here. We've got the launch pad set up here. We push off the launch pad, form this tight area. This forms the key resistance level. We have a gap up, and this is a little bit difficult. It's tougher to buy gap ups for consolidation pivots. I like straight breakthroughs through them quite a bit, but even if you miss this gap up and don't participate, it pulls back nicely on a decline in volume right to that prior level. You've got an upside reversal. This would be the entry day, managing risk at that low of the day. The next day, it holds that level once again, another opportunity to enter versus that level, and then we reconfirm up, go tight, and then start trending really nicely. So this pullback to the consolidation pivot allows you to get in often with tighter risk if you miss the breakout from the consolidation pivot. So even if you miss this day and you feel like it's going to take off without you, keep watching the stock and watch for that pullback into the key level where you can manage risk right at these lows and clearly define your risk in a pretty volatile name that has a lot of potential very tightly versus this level. Ryan, anything you want to add on these two examples, either MSTR or coin?
No, I think, each of these, it's the same concept where, if a lot of traders, when the stock is breaking out, they will enter on this particular day. But the question that you have to repeatedly ask yourself is, can I define my risk effectively? If you can't define your risk, it's it's worth missing this particular stock, even if it does this after the fact. That's fine. You're gonna have, hundreds of trades that you eventually miss in the markets where you have the right idea and you haven't, participated in those. But what hurts the most is when you buy on this particular day, it has a normal pullback. Whereas if you were patient enough for it to come back to the pivot, now you could at least define your risk, right? You could define your risk within 1 to 3% of this, that hey, this should not pull back, you know, more. I'm going to buy it versus this consolidation pivot level. And if it works out, it should turn. And then when it turns, I can maybe add right across here, which is
Yep.
another consolidation pivot on this particular stock. And then it can continue higher. What happens is traders are the opposite. They will miss the fact, they will buy on this day, they will sell right here, and then when they see it, go up, now they don't want to participate right about here because, it's all psychology based, right? So you're buying in the wrong place, you can't define your risk, you get stopped out, now it's hard to buy back. That cycle repeats itself again, again, and again, mostly because your primary, like your first move is the wrong one because you can't define risk effectively, right? And you can't justify, you buy, right near the high of the day here and you sell right here. You're already putting yourself in a really bad situation. And when you do that, the rest of it, then you feel like, oh, this market participant is against me and they are fleshing me out and they're doing this and that. I don't know who they are, but nobody cares about, they're not looking at your account, by the way. So, it's all, becomes a psychological thing where you think everything's, built to be against you because your first step is not correct. Always ask yourself, if I can't define my risk, I don't care how good the company is. It could be the best company in the world. As a swing momentum trader, risk is everything. If you define that, you scale your position size to a matter where, if you missed four of the 10 leaders in the next run and you catch one properly, you will outperform and do really, really well in the market. So always ask yourself, can I define my risk? If I can, I'm going to participate. If I can't, then I'm not going to, and I'll wait for that next train or ticket or bus or whichever analogy that we spoke about earlier in the
Yep.
webinar.
Perfect. And then here's the example with Tesla. I think you talked about this prior. This had so many good examples of pulls back to ranges, tightening, re-breakout, tightening, re-breakout. And the example I just want to highlight is this key level here, this swing high, is then respected and forms a low of this range. And what I love here is this is a tight range. This is about 4% here. And it not only respects this high here, but it also is pulling into the 21 EMA. So again, there's confluence. That's something we want to really focus on here, confluence. And what happens right before it breaks out from this range? Let's zoom in here. Tight inside day. So within this tight range, it gets even tighter after an upside reversal off that consolidation pivot. And you could either buy this pullback to the moving average and as well as the confluence of the pivot, or buy through the high of this inside day. That's kind of more how I would purchase this, is I would see this upside reversal showing respect for where it should show respect to, tight inside day, and then buy here, expecting it to break out of the range. It does, and it's off to the races. And it formed a similar range right above here, and again, shook out and then broke out. And we might even see that later on. I think I have a chart there, but that's kind of the key here is look for a pullback to prior support and ideally confluence between a key level as well as a key moving average like the 21 EMA or 50 SMA. Oh, sorry. Here we go. There we go. All right. Next up, we've got the oops reversal. This is something you really want to focus on here. This is something I learned from JT at Ticker Monkey. Larry Williams developed it for, I think, the futures market. And, it's really, really useful to help you define your risk very cleanly. And the oops reversal focus here, right here, is when we have a gap down below the prior day's low and we rally back through that low. And that low becomes the oops reversal pivot. So I just want to repeat that again. We have a gap down below the prior day's low. And then this is on a daily chart. We rally back through that low. And this is the oops reversal pivot, where is basically the buy point for this entry tactic. And when this happens, up the right-hand side of the base, so this is a base. Think of this as about 4 to 5 weeks here. This is a daily chart. And then we have a gap down, ideally to a moving average, where the low is near a moving average, or a consolidation pivot. I'm showing that confluence in this graphic here. We rally up back through the low, and then we're off to the races and approach that base pivot and breakout. This is a really useful entry tactic up the right-hand side of a base, or even after a base breakout, to position in a leader while managing risk within 2-3% versus the low of the day. I basically 99% of the time place my stop at the low of the day when I'm buying oops reversals, because if we reverse back down and break that low, I know that the oops reversal has failed. So this is a really good entry tactic, and we'll show a bunch of examples here in just a second. So here's NVIDIA in last year. We've got an overall base pattern. It gets choppy. It breaks below the 21 EMA, breaks below the 50 SMA. Here we've got a positive expectation breaker after this very negative bar. It holds. This looks to be the base low. Then we rally up, pull back. Again, a very negative day. We expect a gap down. We get it. But instead of really breaking down, NVIDIA changes course and rallies through this low. So we get a gap down versus the prior day's low and rally back through it. That is the buy point right here. And let me actually even zoom in here just to show it really clearly. We have a slight gap down here, so you can manage risk really tightly actually, and we immediately rally through and really penetrate the prior day's bar. This is the best possible situation where we have immediate strength off the open, rally strongly through that low, and managing risk at the stop, you're automatically up a bunch of risk multiples if you manage risk at this low of the day. So again, thinking about the negative, if you buy this as it breaks through this and we reverse down and break this low, that's where you would exit with your stop loss. But instead here, you have an early entry point up the right-hand side of a base, and you have an immediate profit here to weather any of the pullbacks up the right-hand side. So that is a really good example of an oops reversal. Here we've got TEM. This is a recent leader as well. This got on our radar because of the strong gap up on large volume. We're up the right-hand side of the base, but there's not really a clear entry point up here. There's this little range, this inside day, where maybe you could have entered, but there wasn't much of a tight pivot that formed. But we get an opportunity on this day where we're in a relative strength phase. It's been on our radar because of a strong gap on volume. And what do we get right here? Let's zoom in. And let's zoom in even a little bit more. We get a gap down and a strong rally back through that low. And this is the pivot. This is the buy point, managing risk at this low of the day. And immediately you're at a profit and it closes right near highs. And then we continue that strong trend we've been in. So this is a way to enter a strong trend when there's often overall market weakness. Maybe we get a gap down in the general market based on a jobs number or whatever macro thing is in vogue during that time. And the strongest stocks will rally immediately because the institutions are still looking to accumulate stock, and we rally back through that low, and immediately you're at a profit and join that trend. So this is a really powerful setup, and definitely something to add to your arsenal to work your way into the strongest stocks. Here's an example. I saw somebody wanting a recent example. This is SQQQ back when the market was rallying into the 200 SMA. So SQQQ is, of course, the triple inverse of the QQQ. And what do we have when the market failed right at the 200 SMA? So it's failing at a key level. We get an oops reversal right at that point. As QQQ approached the 200 SMA and failed right at that level, we get an oops reversal, enter through the prior day's low. After the gap down, manage risk at the low of the day. We get the best case scenario where we actually take out the prior day's high as well. And immediately you're at multiple risk multiples and can profit either that day or on a quick swing during a volatile market to profit from market weakness after the market failed at the 200 SMA. So there's a way to kind of use it to short or go against the market as well. But a really easy way to manage risk versus this low right here. This is again would be where your stop is if you enter at the low of the day. This is actually an intraday chart showing that rally off the open. And I just want to show kind of what that looks like. We have the gap down. We have an opening range breakout. We'll talk about it a little bit earlier. This is the prior day's low, this orange line here. So this is the oops reversal pivot. And stop to the low of the day would have been 1.2%. So you're managing risk very, very tightly. Entering here, stop right here, and it just is off to the races. And again, multiple risk multiples right away, immediately takes off. And you could even move up your stop to break even very quickly to manage your risk even tighter. So this is a good example of the oops reversal and what it looks like on an intraday time frame. Here's an example of a downside oops reversal. So just to get advanced for you guys, we've got the key level being this gap up low. We have a breakdown and start of a down cycle here. We respect the 21 EMA, bounce higher, but then the overall market continues and rallies down. And what do we have here? We get a downside oops reversal. So instead of gapping down and rallying higher, we have a slight gap up above the prior day's high and reversal back down. So this would be a short setup, short entry tactic where we gap up, managing risk at the high of the day, short the stock here, and participate to the decline. And there's a lot of good examples recently of this entry tactic on this day as the QQQ in the market failed at the 200 SMA. This one had a gap up, breakdown, fall through to the downside, and continue to move down and form base lows. So this would be a good way to manage your risk very tightly versus the high of the day versus if you're doing it to the upside versus the low of the day. So really interesting entry tactic, definitely worth studying, and you'll start seeing these all over. Here's another oops reversal here. Here's an oops reversal before the gap up. You'll start to see these all over as you look more for these oops reversals. Ryan, anything you want to add on the oops reversal setup personally based on stuff that you've seen?
Yeah, so the oops reversal setup is essentially a failed move
Higher. Yeah.
in the direction, right? And one of the things is, from failed moves, it just momentum goes uh, twofold in the opposite direction, essentially. So learn to spot, especially when a oops reversal is in correlation with a very key area, which could be prior resistance, prior support, or recent consolidation with the undercut, and then you get expectation, breakers off of that. It becomes a really powerful way for, daily or less to execute on that time frame.
Mm-hmm.
So a lot of, when the market opens, a lot of traders look at prior days low as that key area for it to be reclaimed, and then a lot of market forces join and create that momentum to the upside so that the market can rally as well. So that QQQ example was really a really nice example of that, where momentum was created to the upside as soon as we undercut the prior day, we reclaimed the prior days um, level. So yeah, not much else to add there. This is again within the context. You have to take everything within the context of the trend, the theme, the setup, and the edge that you have on the charts. So what we're speaking about today, and I see some confusion in the chat as well, is like this is not about day trading here. This is about, the first three webinars that we did, taking all of that knowledge, and we're now speaking about how do you enter those particular names or those
Yep.
setups using these entry tactics. So you can't just pull up, a penny stock and just say, this is the best it has the oops reversal and it's now the best setup that I see. You have to take all the knowledge that we spoke about in the first three webinars as well.
Yeah, and the key with this particular situation is the QQQ was approaching a key level that it was rejected from, and then this is a leverage way to go short at that time is trading an oops reversal on the SQQQ as the QQQ is reversing back down from its 200 SMA. So that's why we'd even be focusing on this. Again, like I said, we want to really emphasize this. The tactics we're talking about today are always within the context of a larger setup and edges in the market. This is just the last layer about how you actually enter, place your stop, manage risk, all of that. The entry tactic is the last piece, the last step after you've identified a promising opportunity that allows you to actually place your order with a clear pivot point, sell stop, all of that. All right. So let's go ahead and pause for a few questions. So drop any questions right now in the chat that you have so far. And we've got a special giveaway here. You can win a signed copy of the Trader's Handbook once it's out. And basically, in order to enter this giveaway, I'm going to ask a question right now. So everybody be ready. Let's see.
What's you'll post the
No,
question
I'm
or
going to
you'll
ask it.
say
I'm
it?
going to ask it. I'm
Okay.
setting it up right. All right. Are you guys ready? All right. The question is, what is most important about setting a stop loss? What are the two things that I said were most important with regards to a stop loss? I said two things at the beginning, and we covered it on multiple slides. What defines a good stop loss? There we go. John won it. There you go. Tight and logical. It must be tight and logical. Exactly. So tight, remember, means it's within a few percent. Logical means a clear failure of that level. Triggers basically a failure of the entry tactic and setup. Perfect. And I see a lot of other people got it as well. But John, shoot me a DM on Twitter, and we'll get you hooked up with a free signed copy. And everybody else, you can order yours right here. Let me know in the chat, have you ordered your Trader's Handbook just yet? I want to see if there's anybody in here just yet. And I see a lot of people answering, so awesome. Eaton got it. Nice. Braxton got it. Perfect. All right. Thank you so much. All right. Drop any questions you have so far based on what we've covered in the chat here. Let's see if we can answer a few. Let me get a sip of water here. All right. Let me see if you see any questions, Rye. Should the volume
exceed the average volume when you see a oops
I
reversal?
think it's not critical. Ideally, it does, but really, it's about the price movement, and it's going to happen pretty fast in the morning, so it doesn't matter too much. Also, because it's an early entry, we really want to see big volume on the breakout. Earlier than that, it doesn't matter too much, but you'll see the fastest oops reversals are the strongest, the ones that just penetrate that prior day's low, versus the ones that kind of hit it, stagnate. There's not much emphasis. We want to see immediate demand, and that's with a strong price move.
Yeah, anything that's not a base pivot in the markets, there's no volume requirement for consolidation pivots. You want the volume to be higher than previous day. The time frame I'm speaking to right now is daily. On the weekly, when you see a base breakout, naturally the volume will be higher on the weekly charts or for that week because it's a significant level in the markets. But folks I used to wait for volume to show up, and over the years it's become quite clear based on just studying what I missed, trades that I took, trades that I didn't take, that volume, if price is confirming and is way before the base pivot, you can enter that stock as long as you can define your risk, right? And then volume becomes important. You want to see big volume at base pivots. You want to see big volume. It's if you're taking a consolidation pivot and the volume's huge, that's a huge bonus, basically. It's a huge plus, but it's not, a requirement for you to enter.
Yep. I see a question from Gaurav. How do we read high volumes during tight areas? Is that considered a negative? If it's very tight, I wouldn't consider it a negative, but it's not a positive. So I guess that is a negative. But yeah, basically, we're looking for a dry up in price volatility as well as volume during those tight areas. That's what the best ones look like. It's fine if there's one day of increased volume, especially often if there's an upside reversal within that tight area, that will have a little bit higher volume as it stops out people and then reclaims that range. But in general, we're looking for a lower volume than average or a decline in volume versus prior sessions. That's the most ideal situation. Let's see here. You can find the 3 previous webinar recordings in the playlist that we posted earlier, or if you go on the TraderLion channel, you can find that playlist for yourself, but we'll post that later on Twitter as well. Let's see. How much space do you give below stop point? I do it pretty tight, 0.1% below the stop, maybe even tighter than that. If it takes out my stop, say levy. That's just part of trading. Ryan, how much do you usually give below, the technical level to place the stop?
For me, 3 to 4%. Oh, I think I lost your audio.
Can you hear me now?
Yeah, I
Okay,
can hear you now. Yeah.
cool. All right. Let's see here. What MAs work for support confirmation? Look in the past on the stock and see what it respected prior. A lot of the growth stocks I trade respect the 21 EMA during trends. So that's kind of what I like to use primarily. And then the 50 SMA also. What's the indicator we talked about? RMV, relative measured volatility. It's a deep view proprietary indicator. We've got a webinar completely on that on the deep view channel. So you can check that out if you'd like to learn more. Definitely very useful, and you can screen by it as well, which is huge. All right. I think we can keep moving here. We'll answer a few more questions at the end. So here, I just want to mention that, prior to this point, we've talked about kind of entries before the base breakout, but you can use a lot of the same tactics that we talked about shortly after the base breakout. And we want to be entering as close to the base breakout as possible because that's when, the potential reward is greatest. But you could trade a consolidation pivot breakout right after it breaks out from the base. We saw this with Tesla. Then it moves up higher, pulls back to 21 EMA or a moving average for the first time. That would be another spot to add to your shares. If you'd like to trade around a core position, you could sell a little bit into strength here, buy it back versus the moving average, add it on the next kind of mini base breakout. So a lot of the tactics we're talking about, we're using in this area right here, but you can 100% use them later on the base. But we want to emphasize the reward, the potential reward is more worth the risk as close to the base pivot as possible. And ideally you're entering up the right hand side of the base so you can participate in the trend from base to base. That's kind of how I like to operate personally. But yeah, here's Tesla. So here are the entries up the right hand side of the larger base. Then we get a consolidation pivot breakout right above that base. We get a nice breakout. And then we have another mini base right here against the 21 EMA. And, that leads to another trend. So the best stocks will have multiple add-on points where maybe you enter, on this breakout, sell into strength of this key reversal day, add those shares back on, this gap and go off the 21 EMA reclaim. So this is kind of how you can think about trading around a core position and add-on entries after the true breakout. Right. Anything you want to add on this before we get into the gapper entries?
No, I think that area of this one I traded right
Yep.
here.
Same.
It was again a really nice spot, very tight risk, right? The stock had clear upside level. And the best part of this was that the volume died down quite a bit, and we were really focused on this. One other thing, I think if you zoom in a little bit, was the fact that it had one of the, things that we spoke about today was the fact that this level right there was cleared out completely, right? Flushed, then reclaimed,
Yep.
and then it did the consolidation or the pivot area eventually. So let's say I was accumulating versus a level. It did that, the V formation underneath the level, reclaim that. And once it reclaimed that, you got to buy it back and then add to that position. So whatever made the stock special right in this area, right? This is a practical application of what I said theoretically before. You have to, get back into it because that led to this particular run. Again, this area is obviously better, right? If you chased on this day up here and then you got stopped out here, now you're really, sour on this name and you don't want to look at it when it does another tight consolidation. But again, it's a really tight pivot, a really clear entry area, and I'm sure the volume would have died down as well. And then this could have been your secondary, not your primary entry area as well. So the frameworks that we spoke about, these are real life applications of the arrows that we drew that Richard went over, but these are playing out as we speak. Regardless of what the name on the top left of the chart is, the price and the volume will play out according to the frameworks that were presented.
Perfect. Yeah. And I played it on the base pivot reclaim right here. I entered and had a nice move here. Yeah, perfect. Yeah, this is just a great stock to study. And I saw somebody say, it went from really tight here to then breaking down to the 21 EMA. This overall is still within a few percent. So even though this is ridiculously tight, this overall is still a tight range here. So that's why it's still playable on the breakout here. All right. So next up, we're going to get more into the setups for gappers. So these are earnings gappers, catalyst gappers, whatever you want to call it. And the first few we're going to talk about are more to do with trading the day of the gap up. And we talked in the previous session about scans and screens to get gappers on your radar, so you'd be able to trade day one. We'll also talk a lot, but more of that in the routine section. But this is the first entry tactic to trade a gap up. This is pretty classic. I'm sure many of you guys already know this, the opening range breakout. Basically, we've got an initial move up or even down, and then we set a mini base. This is on maybe a 5-minute time frame, a 15-minute time frame, or even a 3-minute time frame. This can happen pretty quick. We set a mini base, and then the buy point is through the opening range high here, setting your stop either at the high or low or at the low of the range, depending on how much risk this is and the quality of the gap and the catalyst. But this would be the entry point, or maybe even early up the right hand side, and we'll show some real examples. This is just kind of the framework to think about, but basically what you want to remember is we've got a big gap up on earnings, a very strong catalyst that looks promising, and then we set an opening range, and then we break through that range and begin trending up on that day. So here's an example with a recent example with Okta. This is one where we're on a 3-minute time frame. So each of these bars is a 3-minute time frame. We have an initial bar that moves up. We have, and let me actually zoom in here. We have an initial bar that moves up. We have an inside bar. So this is setting the opening range. This high is the opening range breakout, and buy point was right through here. And notice how after that, it respects the anchored VWAP pretty much the rest of the day. This is a clear thing that you want to look for on an earnings gapper that's gonna perform and end close really nicely, is respect for the anchored VWAP throughout the day. We close well off of that, and after an intraday base here, we rally into the close, and this opening range breakout, you were never tested. This cost was never tested again, and that's what the best ones do. We want the stock to just go from the opening range breakout. So that is an example there. Let me go to the next one. Here is Tesla back in I believe this was on the election gap here. So here we have an aggressive opening range breakout through the 5-minute high here. So this would be an entry. You do get tested a little bit here, but it respects that area, and often you'll see this be respected later. But we set up and form a bigger opening range here in this area. It's almost a mini base here, and this would be a breakout buy point where you could manage risk versus this high or low, less than 1%. And note how we respect the anchored VWAP and just trend above it the rest of the day, and just steady accumulation. That's what we're looking for on these gap ups, and the most successful ones respect the anchored VWAP as well as just trend higher and grind higher the entire day after the opening range breakout. Here, if we go next, we've got Coinbase. This was based on the catalyst of the election. This is an initial move up, sets the opening range. This would be the opening range breakout right here to the low, to the higher low here would be about 3.5%. That also lines up with the anchored VWAP, but you've got more of an aggressive entry here at the low of the day. Manage risk at 2.5%. So again, these are very aggressive entries for day one. I really want to stress that you do not need to participate on day one to profit from trends. This is more for aggressive traders, advanced traders who want to get the best cost basis possible and really focus on performance. This is more for stage 3+ traders, stage 1 and 2. Can focus on entry points after the true breakout based on daily patterns. This is for aggressive entries on day one. Here is SMCI when they pre-announced their earnings. We've got a 1-minute opening range breakout, an early entry on the anchored VWAP reclaim, and then also through this high would be the opening range breakout. It trends the rest of the day beautifully and just took off here, trended above the moving averages, as well as the anchored VWAP the rest of the day. Then here we've got ASTS from last year. We had the catalyst being a new announcements. We've got initial move up, forms this mini base, this opening range. This is the opening range high. This would be the breakout here, managing risk at the anchored VWAP as well as these swing lows. And you've got an early entry from this tight area here. This would basically be an undercut and rally range breakout that we talked about here on this 5-minute time frame. This would be the early entry, and this would be the opening range entry, and it just took off here. I think gained 20% throughout the day. You've got an intraday base here, which will also be playable. But again, these are for much more experienced traders to play these intraday type setups. And we're only looking at intraday timeframes because there's something significant happen on the daily the big gap up with the catalyst. We're not just looking at this on any old day. We're looking on the specific days where there's a lot of potential for a big momentum move. Here is the next day one type entry. Or Ryan, do you want to add anything on opening range before we go on?
Yeah. No. I think you covered it well.
This is the next possible intraday base. Maybe we've had an opening range breakout back here, but basically we're looking for a substantial basing pattern during the day, still close to the open because we still want the stock to have a lot of potential, but we're basically looking for intraday base to trade with a breakout. You'd set your stop at the higher low after it breaks through that base pivot or an early entry of the right-hand side. This is TEM on the day of the catalyst. I think, I don't know, I think it was just Nancy Pelosi buying it, but that was a catalyst that was working. And this is TEM. It moves higher, doesn't really set an opening range early, but it sends this nice intraday base and this clear tight area. Again, this happens on all time frames, these tight areas on low volume. And this would be the ideal buy point. Range breakout risk to this higher low is less than 1%. And you rallied multiple risk multiples into the close. And also this base breakout, it would also be viable managing risk versus this higher low. So wherever we're buying, we're looking at the higher low and ideally the low of the day to manage risk against, but we always want to keep our risk relatively tight here. All right, here's another example with ELF. This during its really nice move in 2022 through 2023 had multiple gap ups and great examples and great examples to study. This is one during, I think it's May gap up, where we had a really strong move off the open, and then it just went really quiet and tight until this range breakout here. It breaks out, stops to the higher low right here. We've been less than 1% risk. It does retest it a few times, but never really, you don't really experience any heat, any really drawdown at all. And into the close, you're up about 3R into the close. So this is a great way to jump on a gapper and participate in a strong trend after it's shown really nice demand throughout the day. Here's another example, Bloom, where we had a decline off the open. So this happens sometimes depending on the situation. And you can see a pullback, and then we tighten overall. We basically form an intraday base, and you could enter from this tight area. Again, we've got a tight area on low volume. This happens on all time frames, as I mentioned, and buying through this pivot, which is also an anchored VWAP reclaim. So the confluence there, you could risk to the higher low about 2.75%. So very low risk to enter a name that went up multiple risk multiples from that point on day one. Bonus, we've got the anchored VWAP reclaim. This is another way to trade a day one setup. Now, I mentioned it a few times in here, anchored VWAP reclaim. So what actually is that? Anchored VWAP is basically the anchored volume weighted average price. A lot of institutions use it for execution, especially in a stock that they want to build a position in. So when a game-changing catalyst happens, like an earnings surprise, revenue surprise, guidance increase, basically institutions go out and say to their traders, hey, buy me more shares. And often execution is based on the volume weighted average price for that day. And they're judged how good their execution is based on how close they buy versus this volume weighted average price. So this level is a key level of significance throughout the day. And when we first form a range here and reclaim that VWAP, that's often a really good entry point, a little bit earlier than the opening range high here. And throughout the day, you might have retests of the anchored VWAP where it gets respected, undercuts and reclaims at that level. But this is an example of kind of the opening range base here, the anchored VWAP reclaim, giving you a really nice entry in Unity software, which is a recent example from this year. Then next we've got QBTS, another recent one. You had multiple anchored VWAP tests here, undercuts and rallies, but the one I want to focus on here is we have an initial move higher, a pullback, an undercut of the anchored VWAP. Anybody using that as their stop was shaken out, but then it pulled back to this level here and also reclaimed the anchored VWAP, and risk to this higher low here was only about 2.2%, and it rallied nicely from that point throughout the rest of the day. So often undercuts and rallies of anchored VWAP, the first one or the second one, is often a spot where you can manage risk pretty tightly if you're looking to enter on day one of a move. Here's another example of, I forget what stock this is. This might be Okta, I believe. But regardless, you've got a breakout here, nice move. And then look how it respects the anchored VWAP as it builds this base out. You get multiple undercuts and rallies. And I also highlight an intraday base breakout here. This is from a breakdown I did for the Trade Lab, and basically highlighting different entries that you could use on day one. And all these undercuts and rallies of anchored VWAPs allow you to manage risk versus the recent higher low right here. So you'd enter here, set your stop right at this point right here. All right. So that went a little fast. Any questions specifically about anchor view up? Let's see. What's the time frame for anchor view up? You basically watch it on any time frame, but anchor it to the gap up day candle. Let's see here. Are you moving from a 1 minute to a 3 minute? So when a stock first opens, I want to enter on a 5 minute. That's kind of the time frame I want to enter. But when it first opens, I'll watch it on a 1 minute, and then once we get enough time frame, I'll watch on a 5 minute chart. All right. All right. Cool. Where do you put the second view anchor view up? I only put the view up on the opening day here, the opening bar here. And yeah, I prefer 5 minute, but I'm only watching intraday time frames because this is a key day to watch it. I want to be really clear. I've said this before, but I really want to be clear. We're only watching this for a potential day one entry because there's a huge catalyst that's changing how the stock it's changing the character of the stock. And these day one entries are different than the ones we'll talk about later, volume support, range breakouts, because this is only if you want to get involved on day one, which is not necessary if you want to you participate in a trend after the day one entry. But this is for aggressive advanced traders. So most stage two traders should not be looking at this. You should be sticking to daily charts and looking for entries like we'll talk about with Rye in just a second, volume support, range breakouts on a daily chart after the gap up. So with that, Rye, I'll hand it over to you to cover volume support.
Yeah, volume support is one of the entry tactics after a stock shows the highest volume edge that we spoke about. So essentially, let's say, the first day the stock is now shown the highest volume ever or the highest volume since IPO. And we have, this particular day being the day that there's a catalyst, earnings, news, something of an event in the markets. Essentially, what happens is on day two and after, you can form a really good expectation of where the stock will be supported based on the volume distribution of the day that the stock gapped up on. It's a very basic principle that's often overlooked. It's just pure price and volume, supply and demand, and how they balance each other out, and how it creates a really nice zone for you to operate in with very, again, minimal risk, right? So if we go to the next slide, I think getting into an example will make this a lot
So
clearer.
these are
So
daily
let's
charts.
say,
Yeah.
yeah, you could zoom in on the first one, please.
Yeah, these are daily charts,
Um,
guys.
Yeah. So let's say, we're looking at a chart regardless of what company or what it is. I kind of crop that out on purpose. What I want to look at is what happens and what I'm trying to describe as volume support. So this company gapped up on this particular day. It saw massive volume on that particular day. And now when I zoomed in, let's say on the 15-minute chart, or the 10-minute, whatever allows you to see volume support or where the stock is being supported as it comes in, or where the volume distribution was on that day, that becomes an area of interest on the daily frame or even higher. So in this case, the stock had the highest volume in a year. It tried to rally, it didn't work, came back in, and then it was supported when, at the zone that I defined was on a 10 and 15-minute chart, that if it were to get to this level, the supply and demand characteristics, which is price and volume, and what makes sense, it should be supported here if it's a good stock from a technical analysis perspective. So that, the stock does get supported, but most importantly, if I'm operating in this zone and I want to accumulate it, I know exactly where where I should get out. I see this as an inflection point where the stock, secondary buyers or buyers that were waiting or folks that purchased this and institutions that supported the stock to rally on that particular day, they will come back and buy more of that stock because that seems to be a level that they were interested in on the day the catalyst took place, right? So the stock then, this rallies and works out quite well. But what's important here is to understand how we can come up with this, support level based on the day that the catalyst happened. So if we go to the second one, Richard, I'll cover that. So this is another example, this same, and it's another company. that gapped up, had an earnings catalyst, had the highest volume in a year. If you guess it, that would be
I know it.
amazing. But yeah, so it came in, and if you looked at, the distribution of where it was supported intraday on that day and where the volume support came in or where secondary buyers came into that area on the day the catalyst took place on a 10 or 15-minute chart, you would draw this particular zone out. And this stock was constantly supported as it came back into these areas, and it would bounce off of it, right? And the reason I like looking at this, it's the purest form of technical analysis. It's one of the first things that I learned. If something is moving up on volume and comes back in and is supported again right where the volume showed up, that's secondary confirmation that whoever bought it on this particular day is interested in coming back and buying even more as it comes back into that area, right? And that's essentially what volume support is. Um, Someone said BBAI, but that's the next slide. I will be using that. This one is
Yep.
CELH. This was around the 30 spot on CELH. Um, Richard, let's go to the next slide where we get into a real example of a 15-minute chart and how to draw
Yeah.
volume
I think
supports.
I bought this day through the high. You beat me. You got better cost than I did because you accumulated versus that spot right there.
A
Yeah. Yep.
level, yeah.
Perfect. All right. Here we go. So this is hey, look for volume.
So this is zoomed in on an intraday chart. So this stock, again, it doesn't matter what company it is. Focus on the concept so you can apply it to any company, and you don't have to ask me ever again, right? So this stock rallied up, and it came back in, but secondary volume came in, and it was supported here and rallied, after hours. It tried to gap up in the morning. This is pre-market, the yellow comes back in. The stock is then again supported right here in pre-market, holds this level. It's the same level where when it came in, it could have gone even lower, right, from a price perspective, but secondary volume came in to support it to the upside, right? So what I did was I simply, I think this is a level of interest. This is where I can define my risk really, really tightly. And I can know that if a stock were to break this particular area or zone, I should be out of it because that negates, the price support that I defined over here. The why am I looking at, support here and here? The first step to all of this is this was the highest volume in over a year on this particular name on the daily chart. So that's your edge. That's the visual edge that I saw and what makes this a gapper setup. What we're speaking of right now is the volume support. It's an entry tactic. If you don't have an edge to begin with and you just go around looking for oops reversals, you're going to lose yourself and drive yourself nuts because oops reversals and volume supports will be on every single chart that you can possibly pull up in the markets, and there's about 12,000 tickers in the United States. So the first step is this volume was significant on the daily time frame. This was the highest volume and it showed the HV edge. Once I had the edge, I can now I'm on day two, and on day two of this particular, it didn't really do anything. It consolidated sideways. A setup started to form, right? Day two or later on a gapper. And then third is how do I enter this name so that I can define my risk really, really well? How quickly can I know that what I'm doing, is going to result in a losing trade? And how can I define my stop loss really clearly so that I have a thesis to either enter this name with tight stop loss or have a good upside for this. So I enter this name right around the pre-market area, accumulating on the open, accumulated more. The stock then reacted to this level and moved up. Now, is every single one going to do this right away? No. CELH took about a week and a half to 2 weeks to play out versus volume support. This particular stock took 2 days to play out. So there are a lot of questions that I get, and many questions that I saw in the chat throughout is, how long do I have to wait? That's never a known, when it comes to entry tactics. What you're trying to do is dictate where can I manage my risk the best so that when I am wrong, I lose very little. But when I am right, this stock ripped up 43% the same day and I sold it right into, it was too good to be true. So you just sell it and move on. But edge, then a setup forms where you're up below the prior day's high, you're not consolidating, and then you have an entry tactic where you could define your risk really, really well. You enter that name, but if you don't have the first step, a lot of traders forget, if you don't have this volume being significant enough, none of the rest of it matters, and it would have never been on my radar to begin with. So that was the example that I had, Richard. I don't know if any questions.
There's a question if you use there's the indicator fixed range volume to help identify this, but you're more just looking at where the big volume comes in. So maybe
Yeah.
talk about that a
So
bit more.
so Yeah, there's a scientific, I would say, way to do it where you place like a volume profile and it will give you, this bar is big, this bar is small, and that way to do it. I don't do that. I like to look at a chart and dictate, this is where price was supported, volume was good, there's big bars still coming in. There's a reason that price was supported here. There's a reason when it came in here, it was still supported. There's a reason, post market when it came in, it was still supported. There's a reason pre-market there was came in, it was still supported. Well, if it's supported this many times, there's someone sitting there and saying, "Give me more, give me more, give me more." Especially on this bar, there's no reason for it to stop here, but it did, and it was supported into the close, right? So that's why it makes it a significant level for me. Yes, can I be more scientific and say that, oh, the highest bar was here on that profile thing? I just haven't found that to be a better tool than my eyes when it comes to a 10 or 15-minute chart. So that's why I don't use it.
From Mojo says, are stops expected to be hit below this level? Level seems obvious, but with tight stops, attempt is reasonable. I think that's almost the point. The level is obvious, and we actually get an undercut and rally of that level on that day that you bought, into that level and rebounding up from it. So, Ryan, I don't know if you want to answer that additionally.
Yeah, so what I'm trying to say is, we're not trying to nail the absolute low here. What I'm trying to say is I can define my risk really, really
Yep.
well, and I have a zone I can operate in. And if I can operate in this zone, and if it breaks this lower, level and goes to the downside, I know where I'm getting out at. So it could have done this, the lower wick could have been that low, th it would have been that low, maybe I would have not been in the trade or got stopped out. But more often than not, again, there's no absolutes. There's not a lottery. It's not a definitive, 1000% of the time this is going to happen. But with, this is what I've observed with when you have the highest volume ever IPO in a year, more often than not, it will define a clear level of support, and which is what we call volume support on that name.
Perfect. All right. So next up, we've got the high volume close. Ryan, you want to start this one?
Yeah, so the high volume close is it's now quite popular in terms of entry tactics. So essentially, we're looking for the high volume edge. That's the first step. So that's this first bar. And that close becomes of significance uh, as an entry tactic. I don't like it to be my primary, my first way to enter a stock that's, shown the highest volume edge. Uh, it's one of the second or third ways I like to enter a name so that I can, still define my risk quite well. So the entry is essentially at the close of the high volume day or the highest volume, where the catalyst happened, the day that it moves above it, you can place your stop, right underneath the low of that prior day, and that's what people call HVC. Again, I for me, it's not one of my primary entry tactics when it comes to gappers. It's one of the ones that I will use if there's nothing else the stock is giving me. So I like the whole number support. I like the volume support to play out, and those entries I found to be much better than the HVC. But if all else fails and I still, can't find an entry and I see momentum in that name and the market cycle's, still quite young, the group is good, everything else is checking out, then yes, I will take an entry at the high volume close, which is the close of this particular day, and it becomes a key area.
This is a
So
daily chart,
what
by the way,
Richard's,
for everybody. Yep.
yeah, This is again on the daily chart when it comes to this.
So these are setups. What we're talking about now are setups that happen after the high volume gap up day. So after you identify this, you can scan for this really easily. We've got scans in DPU to find these days. These are all setups that you can use after the fact to participate in the trend and momentum moves that these gappers often are the start of. And then here we've got an example where we actually fail the HVC, which can happen. Obviously, we want to manage your risk tightly, and it forms more of a range here under HVC. And we've got kind of a delayed HVC rally here, breakout through, and then this time it works. So that's another way that you can do it, managing your risk right at the low of the day here within a few percent. Right. Anything you want to add before we move on from this slide?
No, I
Cool.
think that's good.
So this is an example. This is Tesla back in 2019. This is a classic one. We had the HV1, and then the next day we went through that close. This is the HVC entry right here, and actually had another HV1. So extremely powerful. Tells you that that setup is likely going to work. And from that point on, we participated in a trend. This actually went parabolic into the 2020 correction. So this is a great example of HVC here, and really big volume on HV1 the first day, and then even bigger volume the next day. This is an example with DocuSign. It actually gave you two days to try the HVC here through these pivots, and this led to a nice move into the end of 2019. And then obviously this was a big winner in 2020 as well. And this kind of started from a nice, I think, 40% move from the HVC entry. Next up, we've got ELF, and I wanted to put this chart on just to show the power of the HVC. And there's so many coincidences where a stock will put in a huge volume move, gap up on earnings, trend a while, and then pull back right to the HVC. And if you mark up every HVC on the ELF chart, every single time almost it retested it, bounced there, and kept on moving. So definitely a really good example to study here with ELF during its trend in 2022 through 2023. Here we've got ASTS. And Ryan, I want to hear your thoughts on this chart, but here we've got the HVE on the partnership announcement as well as earnings. And the next day, it doesn't quite give an entry. I think it pulls back into the HVC and moves higher. But after that, it forms a range right against there and finds support right at that area and sets up a nice range and then rallies. And then later on, we get a continuation, another HVE on another partnership announcement, forms a tight range, and then this breakout from this HVC led to a nice move, and this obviously formed high tight flags and went crazy last year as well. But Ryan, anything you want to add on this example or any of the prior ones?
Yeah, so the biggest thing here is like you identify that the stock has now had a significant move on volume, which makes it special. You'll notice as you track a lot of these HVs that when they happen around that, $5 mark and the 7.5, those are the most powerful ones in terms of how they act. And some of them, you'll be very early to pick them up because people start talking about them in the teens, but something has drastically happened at the lower price range, especially the 7.5 and the 5. Um, I think, with respect to ASDS, higher position sizing here was, easier to do than it was over here if you missed that initial day, right? It's tough to get this particular entry spot where it comes back in and then does the expectation breaker because you're expecting it to undercut the HVC or go sideways or lower, but then it rallies up above the prior day's high. Unless you caught this type of move or you were anticipating a pullback, I think this was an easier entry area when it came to this particular stock. Again, making progress in the market is all about defining risk. If you missed it here, it's fine. If I position size higher and better over here, I could still capture the move on this particular name. And if I missed this one, I'm still tracking it to see if this can give me another move or a really nice risk reward area for me to enter that name. So the key here is, when these things happen, you focus in on them because there's a reason, volume is showing up, people are participating, and the catalyst that Richard highlighted is significant enough for this one. It went crazy. Like even after this particular gap, it kept going. So
Yep, perfect. We've got one more example. This is root, and this actually uses the high as the pivot because this is kind of a variation that might be worth mentioning. Rye, if you want to discuss that.
Yeah, this one's the same thing. Again, yeah, you gotta know the catalyst that is happening here. This one will force you, like this particular momentum name forces you to use the HVC. Maybe the volume support has may have been closer to, a little bit lower. It doesn't give you that. So what I tend to do is when these happen, and I know that volume is significant enough and something's happened in that name for me to track, I boxed it in. I look at the closest hold number as a potential entry area. I look at the volume support zone. I'll draw those out on that particular day, and I'll draw the HVC and the high of the day. And then depending on that next day and the action that where we are in the market cycle, is momentum just starting to pick up, and is risk appetite for these type of names high in the markets, then according to the situation and where we are in the market cycle, that also dictates which entry tactic you're picking, right? In a market where breakouts are failing and strength is being faded, it's hard to go and buy HVC because you know that you're going to get burned on that. In a market where pullbacks are working, volume support and whole number entry areas work a lot better than trying to get into things that are moving above prior day's highs. But this one in this case, like exactly what Richard said, this is a prior significant area. You can call this a base, but I think whatever happened here, this is not a base. This was just a company that was rotten, and something happened here where it came out of the woods, and now something's completely reset this chart, right? So that makes it, a lot of folks that were maybe shorts that were caught or whatever the case might be, cause this momentum to the upside. But what I want to emphasize is a lot of traders say, hey, these gap ups don't work. And that's usually a mechanism of we're late in the market cycle. We'll have a whole webinar on market cycle in this series. Everything and every entry tactic that you're taking will somehow or some way tie into where we are in the market cycle, right? If we're late in the market cycle and we're seeing gap ups in an earnings season, those gap ups usually fade because risk appetite's already, the last 30 days we were in an up cycle. There's no more risk appetite that, there's no more exposure that big firms want to take on at these multiples when we've been trending for the past 30 days. Whereas when we hit an earnings cycle and the market cycle is just starting to pick up, you'll see a lot of gappers go up, gap up and go 30%. So we'll get into the depths of it, but what I'm trying to get at is the entry tactic that you pick will always work best when you correlate it with the market cycle as well. So that will be a topic of discussion in future webinars.
Perfect. All right. The next entry tactic we're going to talk about is basically the consolidation pivot entry tactic, the range breakout that we talked about up the right-hand side of the base, but after a big gap. So often a stock might pause for a little bit and set up a nice range. And that's kind of my ideal way actually to trade these gappers is we have a nice move up. It consolidates tightly, shows support, tightens, forms a clear pivot, and then entering as it breaks through that pivot, managing risk right at that low of the day is kind of my ideal way to trade these gappers. Here's an example with A-Lab. We had a nice gapper here. It pulled back pretty hard, set a pivot right here. I added on this day, I already had a position, but I added on this day, pushed higher, and then even after it moved higher after this range, it set up another range breakout right in this area, 2 tight days, RMV going to 0 right before this really nice reconfirmation. So it can be subtle, but often after a gap up here, there'll be a pause, a range that forms a pullback, and then it rallies and reconfirms higher and really starts that trend after that gap move. Here's Reddit. I added on this one as well. I already had a position before this gap. Gap up showing a lot of strength here. Pullback, gradual pullback. This is the clear pivot. Added on this day. And then even after it pushed up, it tightened up again against the 10 EMA and reconfirmed higher. And you'll see constructive gaps do this is move up, tighten, as they continue to trend above all the moving averages. Here's an example with Tesla back in 2013. Actually, this was a catalyst based on their first ever reported quarterly profit. And this was gapping out of I think 2-year base. So a massive consolidation, game changing catalyst, big gap up. and you might expect it to go immediately, but instead it pulls back hard, breaks all the hearts of people who bought on this day. And then what does it do? It sets up a nice tight range against the 10 EMA. Clear line of resistance here. This is the post gap up range breakout, buy here. And then I think this went up 200, 250% in a matter of a few months. So a really nice historical example here, and a good example of a game-changing catalyst as well, which is always what we look for with the gapper setup. Again, we're not trading any old gap. We're trying to trade a gap that changes the way institutions are valuing a company or see future earnings growth or revenue growth. And proving to the market that it can be profitable is that type of game-changing catalyst that we're trying to focus in on. This is an example of Tesla. Later, we already talked about this actually, but this is an example from the Trader's Handbook, the model book chapter. So if you want a sneak preview of the chapter 12 of the model book, of the handbook, this is one. And this kind of breaks down this HV1, which I already talked about, the HVC right here, but also several range breakout opportunities after that gap up. So that's a good example there. Rye, anything you want to add on post gap up ranges, or any of these examples? I can go back and cycle through any of them.
Nope, I think that was
Cool.
good.
All right. So getting a little bit into trade execution, we've talked a lot about entry tactics. We've, identified a bunch of pivots, different ways to enter a stock, but how do we actually get ready to execute a trade? This is kind of my personal process here that I lay out. First, of course, we're focusing on promising setups and leading themes, showing many edges. Again, we want to be really clear. We're only looking for entry tactics in a promising stock in an overall strong setup. Then I like to narrow down my focus list to 1 to 4 stocks based on their readiness and quality. So how tight are they? Are they part of a leading theme? Is the market cycle right? Are they showing, are they primed with an inside day or upside reversal? All those different qualities are something I take into account. And these are some other things: theme, relative strength, tightness of the setup, number of edges. And then what I like to do, if this is kind of pre-market, and you don't see this bar, this is kind of the current bar. If this is pre-market, I like to set an alert in DView below the pivot, about 0.5% below the pivot. So as the stock approaches that pivot, I'm basically notified and I have time to analyze the setup a little bit more and, do last final checks to see if I want to take the trade or not. So setting that early alert, I think, is really critical. Then I always check, do I have the capability to add a position? Check my risk management. Can I set a tight and logical stop loss? Then I prep my order as it's approaching the pivot after I'm notified by this early alert. And then I enter if everything looks good and it breaks through that pivot. So that's kind of my standard process for trade execution. Setting my stop right after I place my order, or often, in IBKR, I can actually place my stop right with my buy order. So I do that right away. And usually my stop 97.5% of the time is at the low of the day right here. Is kind of how I like to trade these range breakouts. Right. Anything you want to add on trade execution or kind of your process for thinking about actually entering a trade?
No, I think you have to take everything in context. There's a time frame and a situation where these will work. And the the risk appetite of the market will dictate much of what happens when you place a trade, right? So we'll get into the depths of how do we, what we covered today is the framework side of things and how to think of a pattern that forms after you see an edge, a setup form, which is a base or a consolidation, and then how do you enter that name and where do you place your stop loss within that entry tactic. So I know a lot of folks in the comments are very eager to get to the next topics that we will cover in future webinars, but look at these as building blocks towards that. And then we'll get into, when is the best time to get into the markets? When is the best time to step out? How do we build a framework around, when is our exposure supposed to be 80% or higher, and when it's supposed to be 10% or lower,
Yep.
right? So we'll get into many of these things that will all, over the next 10 webinars, everything will tie together. But look at this as a building block towards that. And by the end of the 10, I think you'll have a full system, which is why, we're saying at these 10 webinars in the book will allow you to build a full trading system.
Yep. And we've got a surprise giveaway for everybody watching. if you scan and tweet out a message, which is basically you're attending these webinars and recommend it to others. So if you found this helpful, go ahead and do this. I'll be DMing everybody who does that today with a $50 gift card to TraderLion. So you'll be able to use that on any masterclass. And I'll be choosing one person who does that today. They'll be selected to win a TraderLion masterclass of their choice, whether that's with Oliver Kell, Stan Weinstein, whatever masterclass you'd like. You can go ahead and enter to win by scanning this. And I just want to emphasize what Rai said. Each of the webinars, the purpose of these webinars is to go along and complement the book, because each chapter of the book is designed to cover one aspect of building a trading system. We've talked about laying the foundation, analyzing price and volume. We've talked about mindset, psychology, identifying your stage. We've talked about edges and setups in the previous webinar. This one, the focus is on entry tactics, which builds up on the edges and setups webinar. And in the future, we're going to cover risk management, sell rules, post-trade analysis, writing trading rules, building a model book, finding new edges. The book and also these webinars are designed to help you build a full trading system. And hopefully it's been very valuable to you guys. And hopefully you guys show up to each webinar and find a lot of value in it so we can speed up your learning curves. So that is the QR code. Definitely scan that and help support this resource that we're building. And we would be incredibly appreciative. And I'll be DMing you guys, everybody who participates, a $50 gift card. So this is the end. We'll pause for a little bit of questions. But first I want to say, if you found this video helpful, this webinar helpful, and are enjoying this overall series, definitely go ahead and order your copy of the Trader's Handbook. We had a few people who ordered 2, so that's awesome. That's even better. But basically everything we talk about in these webinars is expanded upon and gives more examples in the book itself. And chapter 12 of this handbook is a full 200 plus page annotated model book of the biggest winners. So all the concepts that we're talking about, edges, setups, entry tactics, you can, look and analyze examples for yourself by studying the greatest winners of all time. And we've made that really easy by including it in the book in chapter 12. So if you enjoyed this webinar, definitely go ahead and order your copy. With that, let's see if there's any key questions. Ryan, anything else you want to mention about the book or these webinar series?
Who is going to be voicing the audiobook was one of the questions.
Yeah, we're still deciding. We're still deciding. Yeah.
No, I don't see any questions. I think, the most important is make sure you join the next one. It's a series. If you haven't watched the previous ones, we'll link them in the chat and also the description of this video. If you guys have questions after the fact and you're watching this, after we finish, we're more than happy to answer those. Do share this with anyone that you think can benefit from it. I think, now is the best time to learn with the current market conditions. We're officially in that bear market from a technical definition perspective, which is, gives you ample time to build a full system, look at your previous runs, what you've done in terms of trading, post-trade analysis, look at your edges, entry tactics, setups, and all of that, while the market figures it out. So this kind of environment doesn't really benefit or, provide an edge to longs or shorts because the volatility is going to be insane. So that's even more of a reason to double down on just studying what you've done, in the past, and also adding more to your game so that you can get infinitely better.
Yep, perfect. And there will be a digital copy. I think you can order the Kindle copy right now. So if you go ahead and scan this QR code, you can order the hard copy as well as Kindle and also the audiobook as well. I actually like to buy the audiobook version and a hard copy, and I like to read it while I know this is crazy. I like to read it while listening to the audiobook, but that's just me. It helps me learn faster. So definitely go ahead and order that if you haven't already. And with that, I think we can end today. So thank you guys all for tuning in. Really appreciate you guys spending some of your Saturday here with us. Hopefully it's been helpful to you guys. I have a ton of fun doing these, and it's great to see all your guys' great questions and thoughts and feedback. So definitely appreciate it. If you're watching this in the future, the recording, if you have any questions, leave it in the comment section. And with that, I think we can pretty much end it. So thank you guys all for your time and your attention. Definitely appreciate it.
Thanks, guys. Have a good weekend.
All right. Cheers, everybody. Bye.